A significant number of investors intend to base a significant portion of their portfolios on dividend equities. Firms that have a track record of consistent dividend payments can produce a constant stream of income to supplement the capital appreciation that comes from investing in growth firms. When conducting research on dividend investing, it is vital to discover firms that have a demonstrated history of raising their dividends on a yearly basis, even when the market is experiencing a bear market. Investors whose primary focus is on dividends gain additional peace of mind from this development. In this video, we are going to talk about dividend stocks for your portfolio. So before starting this video, please like this video and subscribe to this channel for our future updates. Johnson & Johnson. Johnson & Johnson is a legendary blue-chip company that brings in more than $380 billion in annual revenue and is one of the world's largest and most diverse healthcare organizations. Even more astounding is the fact that it has increased the amount of money it pays out in dividends for an incredible 59 years running, earning it the Dividend King. The company's medical devices, pharmaceutical, and consumer health divisions each contribute significantly to the company's consistent cash flows. Its business is resilient during economic downturns since it derives revenue from prescription medications as well as items that are available without a doctor's authorization. Its dividend yield is currently at 2.6%, and thanks to J&J's robust balance sheet and cash flows, analysts anticipate an ongoing increase in the mid-single digits on an annual basis for the dividend payout. It is an excellent core holding for income investors because it is both one of the most defensive stocks and one of the most predictable in terms of its dividend increases. Procter & Gamble. PG is yet another long-standing dividend king that has maintained a pattern of uninterrupted dividend growth spanning over 63 years. Procter & Gamble, which is the largest consumer staples firm in the world, possesses a vast portfolio of well-known household brands such as Tide, Pampers, Gillette, and Bounty, all of which have consistent demand regardless of the economic climate. Because of this, PG is able to generate continuous profits and cash flow, both of which are necessary to pay its dividend. The corporation distributes approximately 60% of its yearly profits in the form of dividends, leaving an opportunity for responsible reinvestment in growth while simultaneously raising its payment annually at a rate in the middle of the single digits. The present yield on PG shares is 2.5%, and the company is expected to continue generating steady dividend growth over the long term, which positions it to be an extremely reliable income investment. Coca-Cola. Coca-Cola is one of the most recognized brands in the world and has a tremendously devoted customer followings because of this. Coca-Cola continues to have widespread distribution because of its extensive bottling network, despite the fact that customer preferences are shifting due to factors such as health concerns and the increasing popularity of alternatives such as sparkling water. Coca-Cola is another top dividend king company because of the robust margins it achieves on its beverage sales and its 319 straight quarters of dividend increases. Coca-Cola generates extremely predictable revenues and cash flow as a result of the sale of its iconic goods in over 200 countries across the world. This enables the company to pay out a 3% yield today while promising shareholders mid-single-digit dividend growth annually. Because of the highly franchised nature of its business model, Coca-Cola should be able to maintain its historically high level of quarterly dividend increase for many years to come. NT provides exposure to the dynamic and expanding cellular market as one of the major businesses in the telecoms industry and a pioneering innovation in the field of 5G. However, this high dividend yield of almost 6% does come with some risk because the firm has taken on a considerable amount of debt in order to buy other media companies like Time Warner. It has pledged to reduce leverage through asset sales, despite the fact that this debt load put pressure on the company's profits. The hefty dividend, which the company has been paying out for over 30 years and increasing on an annual basis, is still a priority for the business. It may be able to restart consistent low to mid-single-digit yearly dividend increases in the event that debt reduction goes according to plan over the course of the next few years. It presents investors with a potential for above-average income, provided those investors are okay with the company's debt levels and strategy for restructuring. The Verizon Corporation. In contrast to AT&T's strategy of using leverage to acquire media companies, Verizon's primary business focus is on the provision of wireless phone service, internet, and television. VZ has been able to retain one of the best balance sheets in the telecom industry because of a more consistent business mix, which has contributed to the company's outstanding operating performance. Verizon has increased its dividend by between 4% and 6% every year for the past 15 years in a row. The current dividend yield for this company is a healthy 4.8%. In the future, Verizon's leadership in the deployment of 5G should make it easier for the company to maintain predictable cash flows as it upgrades its customers to next-generation networks and services. Because of its sound financial management and extensive distribution network, investors know they can depend on Verizon to consistently produce annual dividend increases in the low to mid-single digits over the course of several years. Cisco Systems, Incorporated. After establishing itself as a basic technology underlying the Internet, Cisco has successfully responded to emerging trends such as cloud computing, Internet of Things, and cybersecurity through a combination of internal research and development and external acquisitions. Because of this change, Cisco is able to maintain strong profit margins and generate an ample amount of free cash flow, allowing the company to distribute around half of its yearly profits as dividends. Since 2011, Cisco has boosted its dividend from $0.08 per quarter to its current level of $0.37 per quarter, which translates to an exceptional annual growth rate of 15%. The solidity of Cisco's balance sheet, the breadth of its portfolio, and the company's concentration on high-margin software subscriptions all indicate years of additional low double-digit dividend growth ahead for Cisco. Cisco, which offers a yield of 3% at the moment, is a fantastic technology option for investors who are interested in dividend growth. IBM. Similar to Cisco, IBM has struggled to migrate away from its legacy hardware and towards more lucrative growth areas such as cloud computing, artificial intelligence, blockchain technology, and quantum computing. IBM, on the other hand, possesses enviable assets because of its large financial resources and smart employees. These assets offer IBM the ability to successfully build next-generation technologies through both internal innovation and acquisitions. IBM's new leadership is establishing more discipline, and as a result, the company has focused its investments on the companies that it believes have the most potential while also streamlining its operations. This should assist in maintaining profitability and cash flows, which will be necessary to support a dividend payment that has increased for more than 24 years in a row. IBM continues to be attractively valued given its potential for change, while also giving stable income during the process. The company currently offers a yield of 5% and has historically seen yearly growth of nearly 10% on average. PepsiCo Incorporated. PepsiCo generates around half of its revenue from the sale of beverages such as Pepsi, Gatorade, and Mountain Dew. The remaining revenue comes from the selling of snacks such as Fritos, Ruffles, and Quaker Foods. With a yield of 2.8%, this diversified portfolio contains holdings in a variety of categories, each of which offers an effective and balanced exposure to the reliable consumer staples market. PP began increasing its dividend in 1996 and has done so at an average annual rate of 8% for the past 25 years. At the same time, the company has maintained a payout ratio that is between 55 and 65% of its stable profits. PP should continue to generate sustainable dividend growth in the low to mid-single digits going forward by extending its global reach, adding brands, and bringing innovation such as non-soda drinks. This renowned dividend growth stock provides safety against losses while also providing the possibility for gains. Abbvie. After its beginnings as a spin-off of Abbott Laboratories, Abbvie has grown to become one of the most successful pharmaceutical businesses in the world. Abbvie has made significant investments, both internally and outside, in the research and development of new immunology medications and oncology treatments in order to combat this issue. Its goal is to produce revenue growth in the low to mid-single digits, while simultaneously returning 75% of free cash flow to shareholders in the form of dividends. Since 2013, Abbvie has increased its dividend payout by more than 10% per year, and the company now yields an extremely desirable 4.7%. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.